Back to Josh Trade Wars, and welcome back to another video. And today we're going to teach about candlesticks. Now, I know I've taught about candlesticks before, but candlesticks is one of the fundamental things you need to know and learn in order to trade, because the chart is made out of candlesticks, and that's why you need to know. If you don't know like 100% and don't understand 100% of candlesticks, then you're lost in the game, because your strategy is formed on the basis, on the formation of candlesticks. So that's why it's very important that you learn about candlesticks. And there's a lot of information to learn about candlesticks. It's not just learning like how a candlestick is formed. It's what that candlestick forms into and what that information tells you, and what more can it form into. And that's what I'm going to teach you today. Let's now, to remember what a candlestick is, I'm going to reteach it real quick. What is a candlestick? A candlestick shows how a stock's price moved during a certain time period. It displays the opening, the highest, the lowest, and the closing price. When you look at many candlesticks together on a chart, they form patterns that help traders understand the market and make decisions. So this is the body. For a green candle, the bottom is where it opened, the top is where it closed. This is the highest price it went up to, and this is the lowest price it went up to. For a red candle, it starts at the top, ends at the bottom. This is when it opened, this is when it closed, this is the lowest it went to, and this is the highest. It went all the way down, performed up a little, but still closed right here, forming a red candle. Now you understand what a candlestick is. Let's look at what those candlesticks, many candlesticks together, can do. Here, there's 4 patterns that are really important, and there's like 8 more, I'm pretty sure, other patterns that are very important. So let's start with the bullish engulfing, which is a very important and a very common pattern you'll see. The engulfing pattern occurs when one candle engulfs the previous one, signifying a potential reversal in sentiment. So if the green candle absorbs the red candle, it's going to continue going. It's going to a signal that's going to go up. If the red candle engulfs the green candle, it's a signal that's going to go down. Now for the morning star, this one. These 3 candles pattern signal potential reversal and are particularly powerful when they occur after an established trend. So you can see an established downtrend was a downtrend was established. Now a green candle came in, forming a morning star, and we could see an uptrend. And for the reverse, it's just a reverse, that uptrend, a red candle, the middle candle right here, signifying weak buyers because it's not a big green, so we're weak, and a big red, so sellers came in strong, and now it's gonna come in as a reversal. And then we have the bullish and bearish pin bar pattern. This one right here. A bullish pin bar pattern is a candlestick pattern that signals a potential bullish reversal in the market. The bearish pin bar pattern is the opposite of the bullish pin bar pattern, and it indicates a potential bearish reversal in the market. So as you can see, sellers came in, went all the way down, but buyers and sellers came in, it went all the way down, but buyers pushed it up. So it's going to signify that it's going to continue up. But if buyers came in, pushed it all the way up, but then sellers came right back in and pushed it all the way back down, that signifies that the sellers are strong. If it started right and it went all the way up, but sellers made it all come all the way down, forming this long wick, it's signifying that we have a bearish in the market. So this is a bullish, because it pushed it all the way down, but buyers came in really strong and pushed it all the way back up, signifying that buyers are strong at the moment, and it could lead to an uptrend. Then we have the bullish the bullish and bearish harami pattern. A bullish harami is a candlestick chart indicator suggesting that a bearish trend may be coming to an end. The bullish harami and bearish harami are patterns that can signal a possible change in the price direction, but candlestick charts have many different patterns that traders use to try to predict where price might go next. So yeah, this signifies that it could come to an end. So it's kind of the same as a bullish engulfing, but it's just a pattern maybe coming to an end. And I feel like this one is still important to know, but these 3 are very important, especially the bullish and the pin bar. But it's good to remember all these. You don't have to remember a lot, and focus on the patterns. Once you have that pattern recognition, you'll be in a very good position in your trading journey. Now we have the single candlestick pattern, very important. First, we'll start with the doji. A doji forms when an opening and closing price are vertically identical, resulting in a very small or non-existent body. The length of the wick can vary. The doji represents indecision in the market. Neither buyers nor sellers can gain control, which may signal a potential reversal or continuation depending on the preceding trend. So this is just when There's no decision in the market. Yeah, it's like I don't know where the market's going. The people who are making, like, they don't know if it's gonna go up, they're gonna go down. So it just like as we learned, consolidate. The long leg doji is the same thing. Buyers pushed it up, but then sellers came up. Sellers came and pushed it down, but buyers came up and pushed it up, back up to the middle. So it's like it's kind of indecisive. Uh, then we have the hammer. A hammer has a small body at the upper end of the trading range with a longer wick, twice, at least twice the size of the body. It typically forms after a downtrend. The hammer is a bullish reversal pattern, suggesting that although sellers drove prices lower during the session, buyers stepped in and pushed the price back up, signaling potential buying pressure and possibility of a trend reversal to the upside. So it's very similar to the bullish pin bar. I would say it's kind of the same, but it's formed a hammer. So sellers pushed it down, but buyers came back up and pushed it up, and signifying that it's gonna come back. The hanging man is the reverse of that. So buyers came up, right, and pushed it down, but buyers pushed it right back up, but it's still a red, so we could be forming down. These arrows help. Inverted hammer. The inverted hammer is similar in appearance, but occurs after a downtrend with a long upper wick and a small body at the lower end. It also just suggests a potential bullish reversal. So you can see, boom, it went down and went back up. Then we have the shooting star, the reverse of an inverted hammer. Sorry if I sound complicated, it's just a lot of words. But once you get used to it, it's very easy to understand. Shooting star, these arrows would help you. Then we have the bullish opening marabza. Sorry if I'm pronouncing that wrong. This just means a strong bull a strong bull trend. The market's looking bullish. We have the opposite. It's just a strong reverse trend. Then we have the spinning top. A spinning top has a small body with long wick on both the upper and lower side, indicating that there was a lot of price movement during the session, but neither buyers nor sellers could get control. So this is just the same long wicks on both ends, the top and bottom, and it's just signaling I don't like buyers nor sellers are in control. So it's just a like an even battle. And yeah. Oh, and then we have a doji star. Oh, I already taught the doji. So these single candlestick patterns are very important to understand. And if you want, you can look at the definitions for each one right here if you want. Just go back or whatever, or pause. But yeah, it's very important that you learn these candles so you can develop the candlestick pattern recognition, because trading is all about seeing patterns. Your strategy is a pattern that you want to see to gain money. So that is why you must be able to see pattern recognition, to learn it, to adapt to it, and make it and see it in your own eyes. And you do that over time. So again, I recommend you to do paper trading so you can trade with fake money, but still trade. The more experience, the more better. I think experience is one of the most important things when it comes to anything. I'd rather have fighting experience than be 2 or 3 times stronger than a guy. If I'm fighting a guy who's 2 or 3 times stronger, but I have way more experience, I'm most likely to win because I know what he's gonna throw. I know what's gonna happen next. And like trading, if I have a lot more experience, I know what's gonna happen in that market because I've been in that market before because of my experience. But for a guy who knows everything in the market but doesn't have much experience, their emotion could get to them, or their lack of experience could say, oh, I don't know what's gonna happen because I never had this experience. So it's a unique moment. Trading, nothing is confirmed. It's all about predictions and guessing and making educated guesses. But yeah, that is it for today. Make sure, if you like the video, make sure to like, comment, subscribe, and I'll be getting into another video. Also, I will be posting more on TikTok, so make sure to go down there, and YouTube Shorts. So if you want to see shorter versions, make sure to go onto that, and I'll see you on the next video. Peace.